Today is August 25th, and it's currently 11:09 a.m. Eastern Time. And I'm looking at the daily chart for Merck, ticker symbol MRK. And as of today's candle so far, the stock is at $76.93. And for the day, it's down about 79 cents. So looking at this layout, the red hash lines represents expiration Fridays, and the next contracts expiring is the September 17th contracts. And looking into the most recent pattern, not including today, but for the prior 2 days, there was two down days back to back, 2 red days. So I thought that it would be an opportunity to get into a trade leading into September 17th with the anticipation that price is going to continue dropping, for the fact that typically when a stock pays its dividend, price tends to come down because the price is used by the company to pay out the dividends to its shareholders, and that's an attributing factor for a price dropping prior to a dividend. And according to the market watch here, the next dividend that's paying out by Merck is on September 14th, which is 3 days before my contracts expire on the 17th of September. So when I say my contracts, it's that if I click on the trade tab, I do have a position right here under the options section. Where this green flag is indicating, I do have September 17th contracts expiring in 23 days. So further down here, this is the details to the trade. So I am in possession of the September 17th 76.5 put contracts. Each contract consists of 100 shares of the underlying security. I do have 6 contracts. So 6 contracts times 100 shares, essentially holding 600 shares of Merck up until September 17th, with the anticipation that price is going to drop from $76.90 to my strike price of $76.50. Going further in, my cost basis per contract is 97 cents. The price is now traded at $1.35, and since getting into the trade yesterday, I'm up $229.80, but the daily P&L is 186 for the day. And if I click on the trade details, I got into these trades yesterday morning. I was looking at this chart for prior, I think it was last Friday or over the weekend, and I was just waiting for an opportunity to buy in, and this is when I took the trades. So each contract right here, this is my P&L for each contract. And if I just open this up a little bit, so right now where my contract is, I'm considered at the money because my contract is $76.50. The current price is $76.90, so I'm essentially 40 cents away from being in the money. And once my contract, provided that everything, price continues to drop, once the price hits $76.50, it's going to drop into the in the money section, so it'll be highlighted in purple. So all these contracts, 77, 77.5, and so on, they're all considered in the money because the current price is much lower than what the strike prices are. So the right side is the put side, which is considered bearish. If you have if someone who's thinking of shorting a stock, then it would be equal to buying a put. On the right side, if you were long or bullish on the stock, then you would buy a call contract right here. So this is everything on the right's considered call or bullish. Everything in the center is specific to the contract itself. So all of these contracts expire September 17th, And right below, right next to the expiration date, you have the strike prices. So these are all the stock prices that you can purchase, sell, or create a more advanced trading with like iron condors or like, but those strategies require multi-leg buy and sell. I only do one-sided. I'm only a buyer. So that's my strategy for Merck. However, that's my short-term strategy for Merck. So again, leading into expiration Friday, I'm anticipating a further drop because of the dividend. So it's a short-term play. But when I was looking at this at the weekly time frame, a much broader time frame, I did identify 7116 as the local support resistance level, and the next level that I did identify was 8040 as the resistance for the weekly time frame. So price seems to be respecting this area. Again, because this is a short-term trade, I wasn't even factoring anything above this $80 price. So price has been ranging since January 25th. So price hasn't been able to get above it. So I tried to right here on May 17th, but was rejected and came right back down. And further out, zooming out even further, let's say, since this is the furthest candle I can go back. So this is the monthly time frame. So each candlestick represents a month. So the furthest I can go out is this candle right here, which represents September 2016. And what stood out was that if I draw this and I draw this, right? So this would be, let me just take this off. This would be a pennant, a bullish pennant. So from this low, right? From this low, we would consider this as the flagpole, right? So here's the flagpole, and this pattern here is the pennant. And eventually price is heading towards the apex. So price has been just ranging below these two support and resistance levels since dropping down here in January of this year. So eventually price is going to break towards the upside, because a bullish pennant tends to be a continuation from this trend here, and this is all consolidation, and then eventually go up. Now, in determining the the best guesstimate as to how high it's going to go is that the flagpole would be almost equal to whatever the breakout would be. So this, let's say it breaks out once price gets above this level of 80.40, right? So right around here. So let's say we put, the left side inside the breakout and the outside of this flagpole at the breakout. So this would be, let's say, October, November, right? So if that was to, if the breakout was to occur during that time period, over the next year and a half, it's easy that Merck could reach at $120. So as a long-term play, you know, if I was considering to take advantage of this breakout, or was considering to be an owner of actual shares for Merck, I think now would be an ideal opportunity to start considering, you know, getting into or, you know, start adding some position to it. So again, I prefer to trade options for long-term outlook, and then if the trade does work in my favor, then I would most likely exercise the contract. So right now price is at 76. So if I'm anticipating a breakout, let's say to 92, right? So if I was going to take it to the apex of this pennant, you know, so for May 2022, I would anticipate that price would be at $90, right? So if I go back to the trade tab, so there's no May, so if I look at June, so if I look at June and anticipating that price was going to hit $90, right, I could buy these contracts today at $143 per contract. I'm sorry, $1.43 per contract, or $143 for that trade. So the contract is 143 times 100 shares of Merck. So to own one contract of the $90 call would cost me $143. So as price as price goes up, right, the $75 contract, okay, so if the $90 contract is here and it needs to get into the money here, this would require a move of 1, 2, 3, 4, 5, 6 strikes, right? Because it's at 75 now, which is in the money. So for $90 to be reached, it has to move up 6 strike levels higher, right? So this 143 will eventually be in the $5 range, right? So at that point, each contract would be $500. Whereas now, if I was the owner of these contracts, the $75 strikes, these contracts would move up equally, right? So as this is moving up, the $75 is also moving up. So so that was 1, 2, 3, 4, 5, 6, right? So if it goes up 6 spaces, 1, 2, 3, 4, 5, 6, these $5 contracts would now be worth $17 per contract. So $17.25 times 100 shares, right? So my $500 contract would now be worth $1,700. So also, if I was to buy, let's say, this $90 contract, once I'm in the money, if I want to own these shares, I can actually assign the person who I bought these contracts from, or exercise these contracts. And even though the price is trading at, let's say, 87, well, I wouldn't want to pay for a $90 strike at 87, but let's say best case scenario, Merck overshoots, is so bullish, it's now trading at $105 before my contract expires, because now the price is way greater than my contract is worth. I can actually exercise those contracts and buy the 100 shares at $90, even though the price of the stock is trading greater than $90. So if the stock is at 105, I could buy those at $90. So it's I'm getting the purchase at a discount. So yeah, so that's something to consider. If this trade continues going in my direction, I'm most likely going to consider further out of the money to capitalize on my thesis. So so as time progresses, what I'll do is I'll do another update. Maybe I'll do a follow-up update when the contract expires on September 17th, and then do another follow-up leading into October and November. So until then, more to follow.